You're aware of the typical investments favored by the ultra-wealthy: gold, Bitcoin, property, and equities. This is widely publicized. Financial news outlets dissect these trends with relentless focus. When gold surges to $4,000 per ounce, every publication highlights the influx of hedge fund capital. As Bitcoin nears $100,000, the narrative shifts to the super rich diversifying into digital currencies. Real estate markets experiencing booms are consistently attributed to billionaires actively acquiring properties. This constitutes the public discourse, the dominant storyline, the assets everyone discusses, scrutinizes, and believes they comprehend. However, there's a crucial element often omitted from these discussions. While financial media fixates on gold and Bitcoin, and while individual investors pursue the same opportunities billionaires pursued half a decade ago, the wealthiest individuals have already pivoted. They are currently amassing three distinct assets that have likely escaped your attention. These are assets so specialized that many financial advisors would struggle to articulate their value. They are so fundamental that they will ultimately surpass gold in worth when the prevailing economic framework falters. And their acquisition is being conducted with a deliberate quietude. No public announcements, no media interviews, no social media pronouncements. Instead, it's a methodical, persistent accumulation through holding companies, private dealings, and intricate legal arrangements designed to obscure ownership. I intend to reveal precisely what these three assets entail, the motivations behind their acquisition by billionaires in the current year, 2025, and, most importantly, how you can gain exposure to these same assets without possessing a nine-figure fortune. This endeavor is not about replicating the actions of the affluent. It's about comprehending where genuine value converges when currencies erode, supply chains fracture, and the financial architecture that has supported us for 80 years finally collapses. Let's begin with the inaugural asset. Its nature might initially strike you as mundane, but it is precisely this perceived simplicity that imbues it with significant value. The first asset billionaires are prioritizing is agricultural land. It's not just any land, it's specific tracts in particular locales, possessing distinct attributes that elude general understanding. And the individual who has amassed more of this resource than anyone else in the United States is a figure you are undoubtedly familiar with: Bill Gates. As of 2025, Bill Gates holds dominion over approximately 275,000 acres of farmland spread across the American landscape. This figure is not an error. It represents 275,000 acres. To provide context, this equates to 430 miles of agricultural land, an area larger than the entirety of Los Angeles. It is roughly comparable in size to Hong Kong. One man, through his investment entity, Cascade Investment, controls more privately held farmland than any other individual in the nation. He has been systematically accumulating this asset since 2013. However, the true intrigue lies in the specifics of his strategy. Gates is not acquiring arbitrary parcels of land. He is targeting very particular types of terrain in highly strategic geographic positions. Understanding his acquisition rationale unlocks insight into the foresight of informed investors concerning the next 2 decades. Observe the discernible pattern. Gates's most substantial single landholding is situated in Louisiana, encompassing 69,781 acres concentrated across several parishes. This is not random acquisition. It is farmland strategically located within the Mississippi River Delta. The rationale is rooted in 3 indispensable characteristics of this region. Firstly, the soil quality. The Mississippi Delta boasts some of the most fertile topsoil in North America, a result of millennia of deposition by riverine processes. This is land that cannot be artificially replicated. Secondly, the water accessibility. The land is situated atop vast aquifers and benefits from an unrestricted supply of river water. At a time when water scarcity becomes a global concern, this land guarantees consistent irrigation. Thirdly, the extended growing season. Louisiana enjoys one of the longest cultivable periods in the United States, with some of these parcels supporting 2 full crop cycles annually. The objective here transcends immediate food production. It is about securing control over food production capacity in an era of climate-induced agricultural decline elsewhere. Gates' second largest land acquisition is in Arkansas, comprising 47,927 acres. Again, this is not arbitrary. This region is renowned for its rice and soybean cultivation, and possesses direct access to the Arkansas River, marking it as the preeminent rice-growing area in North America. This is land suitable for water-intensive crops, situated in a region with assured water availability. Are you beginning to discern the pattern? The third significant concentration of his holdings is in Nebraska, specifically on farmland, directly overlying the Ogallala Aquifer, the largest subterranean water reservoir on the continent. This aquifer sustains 8 states, yet its reserves are rapidly diminishing in most areas. Gates has secured land within the segment of the aquifer that is deepest and exhibits the highest recharge rates, ensuring guaranteed irrigation for the coming century. In Washington state, he possesses 16,097 acres, predominantly within the Columbia River Basin. This locale offers an ideal climate for cultivating wheat, potatoes, and fruits, coupled with an abundant water supply from the Columbia River system and established infrastructure for transporting produce to Asian markets via West Coast ports. In Florida, he owns 14,828 acres, primarily dedicated to citrus, vegetables, and cattle ranching, benefiting from year-round cultivation and access to groundwater. Every acquisition adheres to a consistent framework: highly productive agricultural land exhibiting 3 critical attributes. 1. Superior, unreproducible soil quality. 2. Assured long-term water access from rivers or deep subterranean sources. 3. Climatic conditions conducive to multiple growing seasons or the cultivation of high-value crops. Gates's intent is not to cultivate these lands for present-day consumption. It is to secure the capability to control food production when global food systems face disruption. Furthermore, the situation is evolving. Gates continues to expand his holdings. In June of 2025, his investment firm acquired an additional 8,080 acres in Benton County, Washington, for $13,140,000. This equates to $16,000 per acre, a stark contrast to the average American farmland price of $3,000 to $4,000 per acre. Gates paid approximately 4 times the national average. The reason is the land's location in the Horse Heaven Hills region, featuring established crop circles with pivot irrigation systems, direct aquifer access, an optimal climate, and critically, the inclusion of mineral and water rights in the transaction. This last point is of paramount importance, leading us to the second asset being systematically acquired by billionaires: water rights, not water itself. This refers to the legal entitlement to extract and utilize water resources. It may well represent the most valuable asset class of the 21st century. Let me elucidate the mechanics of water rights, as this concept is frequently misunderstood. In the western United States, water rights are legally distinct from land ownership. One can possess thousands of acres of land, yet have no legal claim to the water beneath or flowing through it. Water rights in most western states are administered through a system known as prior appropriation, embodying the principle of first in time, first in right. Those who first established claims to water rights, typically ranchers and farmers in the 19th century, hold senior rights. During periods of scarcity, holders of senior rights receive their full allocation first, leaving junior rights holders with whatever remains, which is often nothing. This is precisely where the value escalates. Water rights can be bought, sold, and transferred independently of the land. If you possess senior water rights in a region experiencing escalating water shortages, you effectively control a substantial reservoir of wealth, as every municipality, developer, and agricultural operation requires water. When supply is constrained, those who hold the rights dictate the price. Billionaires recognized this potential 2 decades ago and have been quietly accumulating water rights ever since. A prominent illustration is T. Boone Pickens, the Texas billionaire who built his fortune in the oil industry. In the 1990s, Pickens began acquiring land in the Texas Panhandle, not for the land itself, but for the water beneath it. This land sat atop the Ogallala Aquifer. Pickens secured water rights sufficient to extract 65 billion gallons annually, an amount adequate to supply a city of 1 million inhabitants. In 2011, he divested a portion of these water rights to 11 Texas cities, including Amarillo and Lubbock, for $103 million. This transaction involved only the legal entitlement to pump water, not the land or the water itself. This represented a value of $1.58 per thousand gallons, a stark contrast to the pennies per thousand gallons that cities typically pay for water from conventional sources. Pickens achieved a tenfold return simply by controlling access. He continues to retain the majority of his water rights, currently valued at over $500 million. Yet Pickens is not an isolated case. An entire industry has emerged, comprising Wall Street firms actively acquiring water rights across the American West. Water Asset Management, an investment firm headquartered in New York, has systematically purchased farmland in Colorado, specifically for its associated water rights. They have acquired over 2,500 acres of farmland along the Colorado River. While the land itself might be valued at approximately $50 million, the senior water rights attached to it are estimated to be worth upwards of $300 million. The firm's president explicitly stated in a 2022 interview that their strategy involves profiting from water scarcity. They acquire land endowed with senior water rights, implement efficiency measures to reduce agricultural water consumption, and subsequently monetize the surplus water rights by selling them to municipalities and developers facing critical shortages. This practice, known as water arbitrage, is entirely legal. In California, the Resnick family has elevated this strategy to an even higher echelon. Stuart and Linda Resnick, proprietors of the Wonderful Company, whose products such as pistachios, pomegranate juice, and mandarins are widely consumed, derive their immense wealth not from these agricultural outputs, but from water. In the 1990s, the Resnicks commenced acquiring vast tracts of farmland in California's Central Valley, encompassing tens of thousands of acres. These land acquisitions included associated water rights. However, their involvement did not cease there. In 1994, California convened a series of meetings concerning water management, a forum the Resnicks actively participated in, while most municipalities remained disengaged. These deliberations culminated in new regulations that empowered private entities to control water banking. Water banks established by the state serve to store water during periods of abundance and release it during droughts. Although these facilities were constructed using taxpayer funds, the revised regulations permitted private corporations to dictate water allocation and pricing from these reserves. The Resnicks subsequently secured control of the Kern Water Bank, California's largest water storage facility, boasting a capacity of 1.5 million acre-feet, equivalent to approximately 500 billion gallons. During droughts, which have become increasingly frequent in California, the Resnicks monetize water from the bank, selling it to other agricultural producers and municipalities at substantial markups. Their billions have been generated not through production, but through the control of access to water stored within public infrastructure. And they are not alone in this strategy. In 2021, the Church of Jesus Christ of Latter-day Saints purchased between 2,000 and 2,500 acres of farmland in Washington state for over $200 million, outbidding Bill Gates' firm in an auction. The question arises, why would the Mormon Church invest $200 million in farmland in eastern Washington? The answer lies in the water rights. This land is accompanied by senior water rights appurtenant to the Columbia River system, ensuring a perpetual water supply. Consequently, the church now ranks among the most significant agricultural landowners in the western United States, not for its cultivation activities, but for the water access it secures. The tactics are becoming increasingly assertive. In 2021, a Wall Street-backed entity named Crown Columbia Water Resources submitted an application to the state of Washington seeking to acquire private water rights throughout the Columbia River watershed. Their proposed plan involved purchasing water rights from farmers, depositing them with the state, and subsequently leasing or selling this water to municipalities and developers. This endeavor would have represented the largest private water rights acquisition in American history. Following public outcry, the application was suspended. However, the company has not ceased its operations. It continues to acquire water rights discreetly through smaller transactions that do not necessitate state approval. The overarching message is clear. Water rights in the American West are progressively consolidating into the hands of billionaires and investment firms who recognize the inevitability of water scarcity. Climate change is diminishing snowpack in the Rocky Mountains. The flow of the Colorado River has decreased by 20% over the past century, and the Ogallala Aquifer is being depleted at a rate exceeding its recharge capacity. Every projection indicates a decline in Western water supplies alongside a surge in demand. In 2030, those who control water rights will command greater wealth than those who own oil, for while one can subsist without oil, life without water is impossible. Now allow me to introduce the third asset that billionaires are actively accumulating. This particular asset is genuinely obscure. Most individuals have never encountered it, and even many financial advisors would be incapable of explaining it. Nevertheless, in 2025, the ultra-wealthy have been investing in this asset at unprecedented levels. It is known as catastrophe bonds, or cat bonds for brevity. Here's a breakdown of what they are and why their popularity is surging. A catastrophe bond is a financial instrument utilized by insurance and reinsurance companies to transfer the risk associated with catastrophic events to investors. The mechanism functions as follows. An insurance company provides coverage for properties in Florida against hurricane damage. Should a significant hurricane materialize, the insurer could face billions of dollars in claims, potentially exceeding its financial capacity. Traditionally, they would secure reinsurance, effectively paying another entity to assume a portion of the risk. However, reinsurance is costly, and its capacity is limited, leading insurers to opt for issuing cat bonds instead. The insurance company establishes a special purpose vehicle, essentially a shell entity. This vehicle then issues bonds to investors, say to the tune of $500 million. Investors purchase these bonds, and the $500 million is held in a collateral account, invested in secure treasury bonds. The insurance company compensates the investors with a premium, typically ranging from 5 to 10% above prevailing treasury rates. Thus, if treasury bonds yield 4%, cat bonds might offer returns of 9 to 14%. In the absence of a hurricane impacting Florida within that year, investors receive their principal back along with the premium, representing a favorable return with minimal risk. However, if a hurricane strikes Florida and inflicts insured losses exceeding a predetermined threshold, for instance, $10 billion, the cat bond is triggered. The $500 million held in the collateral account is then transferred to the insurance company to cover claims, resulting in investors forfeiting their principal. The bond defaults. This is the inherent risk. Investors earn substantial returns by betting against the occurrence of catastrophes. However, if such events transpire, they risk losing everything. You might find this proposition irrational. Who would invest in bonds that could be entirely extinguished by a hurricane? The answer lies with billionaires, pension funds, hedge funds, and sovereign wealth funds, drawn by the exceptional returns and the fact that this asset class exhibits low correlation with other investments. Let's examine the figures. In 2024, the average return on catastrophe bonds was 17.4%. This is not a misstatement, it is 17.4%. For comparative purposes, the S&P 500 yielded approximately 7% in 2024, while investment-grade corporate bonds offered around 5%. Cat bonds delivered nearly triple the returns of equities and more than triple the returns of traditional bonds. In 2023, cat bonds yielded 19.8%, once again significantly outperforming all conventional asset classes. Crucially, during the market downturn of 2025, when President Trump's tariff policies precipitated a 15% decline in the S&P 500, cat bonds experienced a 1% increase. While stocks plummeted, real estate depreciated, and even gold experienced a temporary dip, cat bonds remained stable and continued to provide high yields. The reason is straightforward. Tariffs do not instigate hurricanes, trade wars do not trigger earthquakes, and stock market crashes do not cause floods. Cat bonds are entirely uncorrelated with economic cycles, being tied instead to physical events, natural disasters, that occur irrespective of the broader economic climate. This is a fundamental distinction that billionaires grasp and which eludes many retail investors. True diversification is not achieved by holding stocks and bonds, as both are intrinsically linked to economic performance and tend to decline in tandem during economic downturns. Genuine diversification involves owning assets whose performance is independent of economic cycles. Catastrophe bonds represent the purest manifestation of this principle. The market for cat bonds has expanded dramatically. As of November 2025, the total outstanding cat bond market exceeds $50 billion, a substantial increase from $33 billion in 2020, representing a 50% growth in 5 years. Furthermore, issuance is accelerating. In the 12-month period from August 2024 to July 2025, insurers issued $23 billion in new cat bonds, marking the highest issuance year on record. The surge in popularity can be attributed to 3 primary factors. Firstly, climate change is exacerbating the frequency and severity of natural disasters, leading to an increase in insurance claims. Traditional reinsurance capacity is insufficient to absorb this volume, prompting insurers to seek capital from the markets. Secondly, insurance premiums are on the rise. As premiums increase, so do the coupons offered on cat bonds, making them more attractive to investors. Thirdly, investors have come to recognize the genuine diversification benefits that cat bonds offer. In 2022, both stocks and bonds experienced simultaneous declines, severely impacting a traditional 60-40 portfolio. In contrast, cat bonds demonstrated a 5% gain that year. They are now widely regarded as an essential component of portfolio construction. So, who is acquiring these instruments? Dedicated insurance-linked securities funds such as Fermat Capital Management, Planum Investments, and Stonebridge Asset Management specialize exclusively in cat bonds and manage billions of dollars. Pension funds, including the California Public Employees Retirement System, one of the world's largest pension funds, allocate capital to cat bonds. Similarly, Canadian and European pension funds, along with Middle Eastern sovereign wealth funds, are actively participating. Multi-strategy hedge funds, typically focused on equities and fixed income, are now dedicating 5 to 10% of their assets to cat bonds for diversification purposes. Asset management firms like PIMCO, Amundi, and BlackRock all offer exposure to cat bonds. Even reinsurance companies themselves are investing in these instruments. Swiss Re, Munich Re, and other reinsurers not only issue cat bonds, but also invest in those issued by other entities. This represents a vast and sophisticated market that remains largely unknown to the majority of retail investors, yet its returns are undeniably compelling. Between 1997 and 2025, cat bonds have generated yields that, on average, exceeded their expected losses by 4 percentage points annually. This signifies that, on average, cat bonds offer a 4% premium above what is justified by the inherent risk of catastrophe. This is attributable to investors demanding compensation for undertaking unfamiliar risks and the market's relative inefficiency. Sophisticated investors adept at modeling catastrophe risk can identify mispriced bonds and achieve excess returns. Consider a specific illustration. In 2011, a cat bond named Mariah was issued by American Family Mutual Insurance Company. This bond provided coverage for severe thunderstorms and tornadoes across the United States. It offered investors an annual yield of 6.25% for assuming this risk. Should industry losses from tornadoes exceed $825 million in a single year, the bond would trigger, and investors would forfeit their $100 million principal. Investors calculated that historically, tornado losses had exceeded $825 million once every 10 to 15 years. Thus, they were being compensated at 6.25% annually for assuming a risk that materialized perhaps once a decade. Seemingly favorable odds. However, 2011 witnessed the deadliest tornado season in U.S. history, with over 983 tornadoes causing $21 billion in damages. Industry losses reached $954 million. The bond triggered, and investors lost the entirety of their $100 million. This exemplifies the risk. Yet even accounting for this specific loss, investors who maintained a diversified portfolio of cat bonds between 2010 and 2020 still achieved an average annual return of 11%. This outcome is due to the fact that while a few bonds triggered, the substantial yields from the majority of non-triggering bonds more than compensated for these losses. It operates as a pure probability game. When you hold a diversified portfolio of cat bonds, you will invariably incur occasional losses when disasters trigger specific bonds. However, over time, the elevated yields consistently outweigh these losses, and the returns are independent of stocks, bonds, and real estate. This explains the significant influx of capital from pension funds and billionaires. What is particularly noteworthy in 2025 is a structural transformation occurring within the cat bond market. Historically, approximately 75% of cat bonds were dedicated to hurricane risk in the United States, primarily covering Florida, Texas, and the Gulf Coast. However, in 2025, issuance is diversifying. We are observing cat bonds that cover earthquake risks in Japan and California, wildfire risks in California and Australia, flood risks in Europe, and even mortality risks associated with pandemics. Furthermore, the types of issuers are expanding. Previously, cat bonds were almost exclusively issued by reinsurance companies. Now, primary insurance companies are directly issuing these instruments. In 2025, 58% of cat bonds were issued by primary insurers, an increase from 48% 2 years prior. This signifies that major insurance providers such as Allstate, State Farm, and Farmers Insurance are circumventing conventional reinsurance channels, opting instead to access capital directly from financial markets. The significance of this shift lies in its elevation of catastrophe bonds to a fundamental component of the insurance sector's operational framework. No longer are they a specialized peripheral investment, they are now integral to the functioning of the entire insurance ecosystem. Consequently, this increased integration reduces their perceived risk for investors. The market for these instruments is now more expansive, more readily traded, and more varied, characteristics that invariably attract significant investment capital. The catastrophe bond market in the year 2025 mirrors the state of the mortgage-backed securities market in 2000, an early-stage, specialized arena offering substantial returns, not yet fully grasped by the broader investment community, but experiencing rapid expansion and poised to become a primary asset category. Wealthy individuals are strategically positioning themselves now, before mainstream investors catch on and before interest rates inevitably decline. Let me illustrate this recurring pattern. Consider these three investment categories: agricultural land with access to water, water usage rights, and catastrophe bonds. What unites them? Each represents a scarce, indispensable, inflation hedging, and disaster-resilient asset. Let's examine each facet. Scarce. It is impossible to generate more arable land with prime soil and reliable water sources. Such land is a product of geological processes spanning millennia. The quantity of land situated above deep aquifers is finite. Similarly, one cannot create additional water rights. These were legally established in the 1800s. Furthermore, the incidence of disasters cannot be increased. Catastrophe risk is intrinsically linked to geographical location and climatic conditions. Essential: access to sustenance, potable water, and protection against unforeseen events are fundamental human necessities. While other expenditures may be discretionary, these three are non-negotiable. Inflation-proof. As the value of currencies diminishes, the price of agricultural land tends to rise in tandem with food costs. Water rights become increasingly valuable with growing scarcity. Catastrophe bonds, with their variable interest rates linked to inflation, see their yields increase as inflation rises. All three of these assets retain their real value irrespective of currency devaluation. Disaster resistant. This is a crucial attribute. Farmland has demonstrated resilience during economic downturns, enduring the Great Depression and the financial crisis of 2008, and is expected to weather future economic storms. Water rights are inherently resilient. Indeed, disasters can enhance their value by constricting supply. Catastrophe bonds are specifically engineered to withstand catastrophic events. Their attractive yields are a direct consequence of their lack of correlation with broader market downturns. When equity markets plummet, bonds default, or currencies collapse, these three asset classes continue to generate value. Billionaires are not acquiring these assets for modest annual returns. They are securing them as a means of wealth preservation for the next 50 years. They are preparing for a global landscape characterized by monetary instability, food shortages, escalating water costs, and volatile traditional financial instruments. These are not schemes for rapid wealth accumulation. They represent a safeguard for civilization itself. This naturally leads to the question: how can one gain exposure to these assets without possessing immense wealth? Acquiring 69,000 acres in Louisiana is out of reach. Competing with figures like Bill Gates for farmland in Washington is impractical. Negotiating with Texas ranchers for water rights from the Ogallala Aquifer is likely unfeasible. And certainly investing the minimum of $10 million in a catastrophe bond fund is beyond the reach of most. However, obtaining exposure is possible. Allow me to demonstrate. For agricultural land, the most accessible avenue is through farmland real estate investment trusts, AREITs, which own farmland and distribute income. Farmland Partners, trading under the ticker symbol FPI, possesses 177,400 acres spread across 300 farms. It issues quarterly dividends. Shares can be purchased for approximately $11 each as of November 2025. Gladstone Land Corporation, with the ticker symbol LAND, manages 168 farms encompassing 112,000 acres, with a focus on fresh produce and high-value crops. It provides monthly dividends with shares priced around $15. While these are not perfect substitutes for direct land ownership, one forfeits certain tax advantages and direct control over water rights. They offer exposure to the appreciation of farmland values and income generated from agriculture, and can be accessed with an investment of $1,000 rather than $1 million. Another option is fractional farmland investment via platforms such as Acre Trader and Farm Together. These platforms aggregate investor funds to acquire individual agricultural properties. Investments ranging from $15,000 to $50,000 can be made in specific farms, granting ownership of a proportional share. Investors receive a corresponding share of crop revenues. Some platforms even provide detailed information about the specific farms in which one holds a stake. This offers a closer approximation to direct ownership than a REIT, yet remains within reach. Regarding water rights, direct access is considerably more challenging due to the absence of a public market. Water rights are transacted privately, but indirect investment avenues exist. Consider water utility companies. Entities like American Water Works, ticker symbol AWK, own water rights and associated infrastructure across numerous states. As water becomes scarcer, utilities that manage rights and distribution operations stand to benefit. Xylem, ticker symbol XYL, manufactures pumps, filtration systems, and water management technologies. With increasing water scarcity, demand for their products naturally rises. Water-focused exchange, traded funds, ETFs, also offer exposure. The Invesco Water Resources ETF, ticker symbol PHO, holds a diversified portfolio of companies involved in water infrastructure, utilities, and technology. While not a direct investment in water rights, it is closely tied to the underlying trend of water scarcity. None of these options are perfect equivalents to possessing senior water rights on the Colorado River, but they provide exposure to the value derived from water scarcity without the complexities of negotiating intricate legal rights agreements. For catastrophe bonds, access is now readily available through mutual funds and ETFs. The Stone Ridge High Yield Reinsurance Risk Premium Fund, ticker symbol SHRIEKS, invests in catastrophe bonds and other insurance-linked securities. Minimum investments for some platforms start at $1,000. The Pioneer Cat Bond Fund, ticker symbol CBYX, is another mutual fund concentrating on catastrophe bonds. These funds offer access to the same asset class utilized by pension funds and hedge funds, but packaged as mutual funds with daily liquidity. The primary drawback is the associated fees, typically ranging from 1 to 2% annually from management, which can impact returns. However, this fee covers professional management and diversification across numerous catastrophe bonds, an advantage not easily attainable by individual investors. Additionally, the Swiss Re Capital Bond Index, which several ETFs track, provides broad exposure to the entire catastrophe bond market. While returns may not match those of the highest performing individual bonds, they offer market average returns with reduced risk. Let me be unequivocally clear. This is not financial counsel. I am not directing you to purchase these specific assets. My intention is to illuminate what affluent investors are acquiring and the rationale behind it. Your decision to follow suit should be based on your individual risk tolerance, investment timeline, and financial circumstances. It is imperative, however, to comprehend the underlying dynamics. The wealthiest individuals are reallocating capital away from conventional assets and into tangible, scarce, and essential resources. Their motivation is not the prospect of achieving 20% returns next year. Rather, it stems from a conviction that the current financial system is inherently unsustainable. When it falters, the critical assets will be food, water, and disaster protection, not stocks, bonds, or even cash. The assets that generate food, the rights that govern water access, and the instruments that transfer disaster risk from one's balance sheet are the true wealth preservers across periods of systemic transition. They are accumulating these assets now, in 2025, before the majority recognizes the impending shifts. Bill Gates did not become the nation's largest private owner of farmland by chance. This was a deliberate, 12-year strategy. T. Boone Pickens did not fortuitously acquire water rights valued at $500 million. He purchased them when their significance was unrecognized by others. Pension funds did not allocate billions to catastrophe bonds out of mere curiosity. Their analytical models indicated that traditional diversification strategies had failed in 2022, necessitating uncorrelated assets. The pattern is evident, the trend is undeniable. The crucial question is whether you perceive it in time to adjust your own strategy. These are not the sole assets being amassed by the ultra-wealthy. Other categories include rare earth elements, nuclear energy infrastructure, agricultural technology, and strategic commodities. However, farmland with water rights in isolation, and catastrophe bonds represent three categories currently experiencing peak accumulation and remain accessible to individuals who are not billionaires. If there is one takeaway from this discussion, it is this. When you observe billionaires systematically acquiring seemingly mundane assets that appear disconnected from the prevailing market, pay close attention. They are not investing for the present. They are preparing for a future where conventional systems fail. On that future day, the individual who controls food, water, and risk transference will possess significantly greater wealth than the holder of stocks and bonds denominated in a currency that has lost its efficacy. This is not an assertion of impending doom, but rather an observation of historical patterns. Every reserve currency throughout history has followed a predictable trajectory. In each instance, the financially astute who foresaw the transition redirected their capital into real assets years in advance of the systemic change. This moment is analogous. Your choice to act upon this understanding is entirely yours.